Hi, I'm Jimmy. In this video, we're going to use economic indicators to see if we can objectively gauge where the US economy stands today. Spoiler alert, it's not very good. Okay, so the goal is to see if we can get enough of a big picture perspective on the overall economy to help us make better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, let's jump right in. So this is the Baltic Dry Index. And basically what this index does is it measures the cost of shipping raw materials. And this index is actually comprised of 3 different ship sizes that ship raw materials. 40% of the index is made up of Cape-size ships. They're the biggest ships. And then 30% are Panamax. And then the other 30% is Supramax. So this index looks at the cost of shipping for each of these ship sizes, averages them together. Now, when we shift back to the 5-year chart, well, what's useful about the Baltic Dry Index is mainly it's a leading economic indicator. And we can see that back in last September, the index peaked and started to head lower. Now, even before the coronavirus hit, manufacturing was starting to decline around the world. And this first became obvious in the Baltic Dry Index. Now, if we were to focus more on this recent activity here, well, we can see that the index started to move higher, but then it pulled back once again. Now, I think it's important for us to remember that this index tracks the price of shipping goods. So really, what we're looking at here is the broader trend of demand. And in theory, lower prices could lead to more demand for shipping. Of course, we're waiting for many of the economies around the world to open up again before that demand is likely to hit. But either way, this is tracking the cost. So for now, I think it's fair to say that there is an overall lack of demand of shipping of raw materials, and that's likely to be a bad sign for the economy. Okay, now let's shift over to a somewhat related index in the ISM Manufacturing PMI indicator. Once again, we can see that this indicator has been heading lower. So the key level for this indicator is 50. Anything above 50 means that the manufacturing sector is growing. Anything below it means the manufacturing sector is shrinking. And just like we saw in the dry bulk index, manufacturing had peaked more than a year ago and started heading lower. And then when the coronavirus hit, well, we can see that manufacturing really got hurt. Now, once again, this manufacturing is likely to be a drag on the overall economy. We need to see signs of a turnaround in indicators like manufacturing or housing or jobs. So clearly this is negative for now. But now let's take a peek at housing to see how that's going. So this is the economic indicator that tracks housing starts. And what this indicator does is it tracks the number of new houses being built. Now, it may not be surprising that less houses are being built given how many different parts of the US economy are currently shut down. The question will ultimately be for us, how fast does this come back once the economy opens back up? My guess is the recovery in housing and a lot of other things are going to be fairly gradual. So it may be fairly obvious that the economy as a whole is struggling right now. And when we look at jobless claims, well, this is very apparent. And many of us may know that this has looked recently. There's been more than 40 million initial jobless claims in the wake of the coronavirus, and this is the worst level since the Great Depression. And once again, it's my opinion that the recovery from the loss of these jobs is likely to be somewhat of a long road. And it's probably no surprise when we switch over to consumer confidence that this has taken a giant hit as well. And it's going to be tricky to see where consumer confidence goes from here, but I'm not too surprised that consumer confidence numbers aren't as low as they were back in the Great Depression, or not Great Depression, Great Recession, the financial crisis. And I believe that that's at least partially due to the fact that there's an external factor that we can blame on this particular crash, which is obviously the coronavirus. And I think that allows for many investors to believe that once the coronavirus is behind us, the economy has the potential of jumping right back up on its feet and start moving forward again. And I certainly hope that happens, even though I fear that broad confidence in the overall economy could take a while to come back after things do open up again. Now, I know I went through a lot of those economic indicators somewhat quickly because, let's face it, nearly all of them are saying the same thing, and that's that we are in a bad economy right now. But I'm not too sure that that's going to be much of a surprise for anybody. And if we look at what's happening with the S&P 500, well, the S&P 500, which is often used as a leading economic indicator, looks to be saying that there's at least signs that things will turn around in the overall economy. They say that the S&P 500 is a good predictor of where GDP will go. Hopefully soon, based on how much the S&P 500 has moved. But Let's face it, the S&P 500 is a very fickle indicator for us to rely on. One day it's up really big and then it could be down just as big, maybe more the next day. Sure, we can see something with the broader trend, but I still don't feel totally confident relying on the movements of the stock market as a predictor of the economy. So now this leads us to our initial question: do we invest now or wait for another pullback in the stock market? And I have two trains of thought for this one. If we do dollar cost averaging, which is when we consistently invest every month or every week or every year or every quarter, whatever it is, well, I think it makes sense for us to continue to do just that. The strength of dollar cost averaging is its consistency. And almost no matter what the market is doing, I think we should stick with that. But if you're like I am and you like trying to invest when we find good opportunities, now I don't mean us trying to time the market, trying to time the bottom or anything like that. I mean, we do the research on a particular stock or bond or whatever it is. We find a company we like, we try to calculate its fair value, and then ideally we buy it below our calculation of fair value. And where I think this type of analysis, where we go through the different economic indicators, could be useful, in addition to giving us a broader snapshot of the broader economy. By the way, we do these videos every month, so we can sort of get running updates on where things are, try to get a big picture. But I also think looking at the different indicators can perhaps give us ideas about where there's weakness or where there's opportunities. For example, we saw weakness in the manufacturing sector. Are there any manufacturing companies that are priced nicely today that perhaps in the next few years we could feel fairly confident that they will recover and ideally their stock would move higher? Maybe there's opportunities in the home builder stock. We saw that sector's been hit. Maybe in the dry bulk shipping stocks. We saw that index, the Baltic Dry Index, has been hit as well. So perhaps there's some stocks over there. So if you know of any industries that you think would be worth a closer look, maybe one of the ones that we went through today, perhaps we can do an analysis on that whole industry and maybe try to identify the top 5 or 10 companies that could be potential investments from that particular industry. Let me know in the comments below what industry you think we should start to deal with first. And besides that, I think it's important that we focus on our research process to continue to try to identify strong companies based on our own analysis. And if you're not too sure of a good process for analyzing stocks, I actually did a video where I go through an 8-step process that I use for how to research a new company and ultimately how to try to determine if that company is a good investment for each of our own portfolio. If you're curious, that could be a good next video for you to watch. There's a link right here and there's a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.